Hello everyone, good afternoon. Welcome to our latest quarterly investment outlook. Although it might not look it given the virtual background that I've got, there's a few of us that are actually managing to come into the office, and this is the first time for quite a few of us that we are doing part of our investment outlook from the office, even though given social distancing we're all in different meeting rooms, so it doesn't feel too different from our perspective. Thank you for joining today. We are going to be going through the usual outlook, summary of performance, summary of where we are from a portfolio perspective, taking a little bit of a dive into the macro world, exploration of how things are looking on the fixed income side, and then starting to explore a couple of themes that sit within the equity component of our portfolios. And then, given it's such a topical discussion point at the moment, we've kind of added on a special focus part on the US election. I'm anticipating that the people at Dolfin side talking about the US election will be slightly better behaved than the presidential candidates themselves. Usual suspects listed on the right-hand side who are going to be stepping in and talking about their areas of expertise. As per normal, this is obviously being recorded. You can get a link to the recorded session, so you can watch this as many times as you would like to. We have got the ability for you guys to chip in with any questions that you have as we're going through, and we will try and put in these deliberate pauses in between each section, just to try and give a bit of time to recap, but also answer, and then we can come back at the end if we don't get a chance in between the sections. And then right at the end, there will be some contact details if you have any follow-up questions, queries, things that you'd like to hear about at the next monthly investment outlook. So without further ado, we'll sort of kick off broadly on the performance side, and obviously looking back at Q3, which was broadly positive from a performance perspective, although September had a little bit of a negative drag down into the end. From our perspective, we finished off September, we've still got, on a model perspective, all 9 of our global multi-asset models in the 3 different currencies that are running them are positive on a year-to-date basis. And although when I start to look at a little bit of the asset allocations, it looks at a top line level like we haven't changed too much. And we have sat and watched a lot of the markets in Q3. We did start to make some allocation decisions and rotations within asset classes, which we'll sort of touch on briefly as well. So just to cover, we've seen on the top right-hand side, you can see global equities and even the US underperforming Europe for a little bit. So we had sort of that 2 to 4% pullback in the equity markets, a little bit more severe in some of the commodities. That's kind of transferred across from a September performance number for our mandates, ranging from a sort of 20 basis point to 100 basis point loss for euros and dollars. But as you can see, some of the more conservative models still managed to generate positive returns in September. This kind of comes back to our mantra with the focus on absolute return and trying to continually generate this positive performance on a month-by-month basis. We have, for a lot of the sterling and dollar mandates, I think this is the second negative month for our dollar mandates in the last 18 months. So given some of the volatility that we have seen in the especially equity markets over that period, we are quite happy that we've kind of managed to limit a lot of that downside. On a year-to-date basis, that means slightly strangely from a dollar perspective, our conservative, balanced and growth are all fairly similar from a performance perspective, all in excess of the target return, but we have had different drivers given some of the performance of longer dated bonds for both dollar and sterling mandates, which has seen conservative get a bit of a kick through on the performance front. It is strange to note that from an equity perspective, the MSCI World only up 2% on a year-to-date basis as at the end of September. So from a performance perspective, we are happy and comfortable with what we have been generating. The piece of information that we haven't got here is more around the volatility side. And when we're looking at a downside protection, we have seen that with very, very low single-digit volatility for the underlying models. And that's what we're looking at from this risk-adjusted return perspective. So we have been very happy and comfortable with those numbers. So for all 9 of our multi-asset models, as I said, remaining in positive year-to-date performance territory, which we're happy with. Just in terms of a very, very brief Q3 look back, as I said, it looks at a fixed income and equity perspective, but we haven't been changing too much. What we did do towards the end of Q3 was just start to take profits in some of our essentially US tech allocations, and we ended up rolling internally. So we didn't take it out of equities, we rotated it across to more say material-based names, which is how our global equity allocation has increased in Q3, partially at the expense of our satellites, but all of our underlying names we continue to be happy with and very comfortable. Ditto on the fixed income side, we've made a couple of switches and reallocations, wanting to be a bit more nimble given some of the underlying macroeconomic movements in terms of having control over where we are in the capital structure, and also taking a lot of consideration into how much credit risk and duration risk we are comfortable holding on to given the current, as I said, underlying economic environment. A lot of what we are doing now has been monitoring our position, obviously, as we're heading into this US election, but realistically, a lot of our focus is already starting to switch to 2021 and our positioning for that market and economic environment, because it is going to be quite challenging, and it has resulted in us changing over the last 6 to 9 months quite a lot of our mindset, approach and construction of the model portfolios. That is essentially it for me. I'm not anticipating too many questions, given that the really interesting and juicy stuff is just going to start in a second with my colleague James, who arrives bang on cue, and I will pass across straight to him to talk us through some of the macro top line thoughts.
Thank you very much, Simon. I guess timing is everything in life. So let's go through what we've seen in the last quarter and what we see in the quarters ahead on the macro side. At the top level, we're going to talk about how markets have swiftly but only partially recovered and what we think happens after that. There's a very disparate kind of economic pattern in the markets. We've seen strength in goods, but really substantial weakness in the service sector. And that plays out in our investment themes and in commodities like copper and crude. And then finally, we're going to talk a little bit about the implications of interest rates being pinned to zero as a really key driver of what's going on in really all the markets. So let's go ahead and get started with what's been happening over the course of the past few months. So there have really been 3 phases to the summer this summer in the financial markets. So on the left-hand side, I'm showing you equity total returns, and this is indexed so that the pre-COVID February 19th peak is equal to 100. So from that point, all of the markets broadly just fell in sync, and by proportionally about the same. This is exactly what you would expect. It was a risk-off phase that was. It requires little explanation. The global economy was locked down, and the markets responded. The second phase, which started in March and in the end of March and continued through July, was reflation. And this reflation had something to do with an unlocking process in the economy, but it had more to do with markets pricing in not just fiscal stimulus, but also the tremendous decline in interest rates. The Federal Reserve and other central banks around the world taking rates as close to zero as they possibly could. And this is really important. I think this has been the key driver of the reflation that we've seen in the markets. So the BIS, the Bank for International Settlements, which is sort of the central banker's central bank, has done the math, and they estimate that something like a half of the rebound in the US equity markets and about a fifth of the rebound in Euro area equity markets is simply because interest rates going to zero make future corporate earnings look more attractive today, nothing else. So it's just a repricing effect. So that repricing effect is largely gone through, and by the time we get to August, I think the markets have generally moved sideways. You can see that with the equity total returns on the left-hand side, On the right-hand side of your screen, you can see the exact same pattern where high yield spreads, the OAS spread to treasuries, has just moved sideways since August. Now, some people might say, well, but the S&P 500, it rallied in August. Actually, it was US tech mega cap stocks which rallied in August. If you strip out the US mega cap tech stocks, the rest of the world just kind of went sideways. And I think this is really important because I think this is where we think the world is going to be in the quarters and maybe even the years to come, that we're going to see risk markets moving sideways in a very wide range. And this is quite important. One, it tells us this is not the market where you simply want to dive headlong in and wait for long-term trends to cover up any errors you make on timing. And secondly, it means that you're going to have to be a lot more active in looking for different sources of return. So a good way of getting into, I think, how these different sources of return are going to be motivated is to kind of dig into how this recession has played out on the real economy side. I could show you 100 charts, but time limits me to one. So what I'm showing you here is personal consumption's expenditure in the United States. So this is about 2/3 of the U.S. economy, the part of the U.S. economy that's not government spending and net trade. And you can divide that into what U.S. consumers or the U.S. private sector sends on goods, stuff you can drop on your foot, and services, haircuts, trips to the movies, that kind of stuff. What typically happens in a recession is that goods demand falls sharply and takes a while to recover. You can see that on the left-hand side. In 2008, there was a steep decline in consumption of stuff, and it took a few years to get back to the pre-recessionary levels. Services, by contrast, typically has a very narrow decline and recovers rather quickly. Our hair still grows. We still need a haircut. We can delay a purchase of a new iPhone, but it's harder to delay that haircut. What we've seen this time is really quite striking. Goods demand rebounded very, very sharply. There's two things that are driving this. One is governments gave people money to keep them afloat during the lockdown. And then people went out and they spent that money online shopping, for example. It's the Amazon economy didn't stop during the lockdown recession. And so the goods producers, they've done reasonably well. Services producers have really struggled. Movie theaters are closing still. Airlines are really, really struggling. And this is very, very important because services are about 2/3 of the total output, the total expenditure. So without the services side of the economy turning on and moving us forward, I think it's going to be a really, really difficult recovery. And for that reason, one of the possibilities that we have penciled in is a double dip recession. This is something which I think probably creates opportunities because the markets will then sort of unpack a lot of really interesting relative value trades, differentials between different markets. Let me sort of explain one possible differential, one that I think has been really, really interesting, and that it helps us sort of encapsulate this sort of two-speed economic recovery that we've been seeing. So if you compare copper versus crude, you can see really quickly, copper is something, again, that you can drop on your foot. I wouldn't suggest you drop copper on your foot, it might hurt. But it feeds into that good side of the economy. It turns into iPhones, into televisions. It turns into infrastructure, which a lot of governments are turning to as a way of stimulating their economy. Crude is a lot more attached to the service side of the economy. Crude when airlines, air travel requires a lot of crude oil. Driving to the movies requires gasoline. And so what we've seen is a real divergence. Copper sharply outperformed, and this is something that has taken a very recent kind of explosive nature. So if you look at the far left-hand side chart, What I'm showing you here is the flat price of copper versus the flat price of crude. And I'm looking out in the future, 15 months, the 15-month rolling forward. Those are typically pretty tightly linked because they're being driven by the same sort of underlying business cycle. Now that started to diverge in 2014 when Saudi Arabia flooded the market with crude in order to shut down US shale producers. Never really recovered. But then what we saw in 2020 was a real sharp divergence. And that's because demand for crude oil just absolutely went through the floor. And if you recall, what we saw was some really crazy market activity earlier this year. You might remember that we had negative prices for front month crude. We had the contango. So the contango it describes a forward curve where the nearer dated prices are much lower than the longer dated prices. That contango went to sort of unheard of levels. And the reason was there was so much crude sloshing about the market that people were aware that they may not have any place to store it. Now that super contango is something which before the 2000s you never saw. I mean, that was basically unheard of. But since the 2000s, this is now our third episode of super contango. It's becoming a bit of a pattern. And what that's done is it's absolutely destroyed the returns from being long crude oil. So if you put these two pieces together, the flat price story and the time spread story, what you get is copper being a much, much better investment over the past 15 years. It's returned almost 4 times as much as crude oil. Now it's a pretty volatile trade. Sometimes it swings the other direction pretty fiercely. So it's one that we approach with a bit of care. Longer term, we think trades like this are going to persist, and it all drives back to that differential which we're seeing in the goods side of the economy, which has done really, really well, and the services side of the economy, which is very face-to-face and it requires you exposing yourself to other people, which I think is probably going to struggle for at least a little while longer. So if we start now looking at how some other parts of the economy have been doing as a reflection of, if we could look at the next slide, please, as a reflection of these differential or these disparities that we see in the economy. Let's talk about the dollar. So one of the things that's happened over the course of the past 6 months or so is that the entire world has basically driven interest rates down to zero. Now, this is a trend which we've been flirting with for a few decades. So the Japanese central bank, the BOJ, went to zero rates about 20 years ago. The ECB and the Fed went close to zero rates about a decade ago with the global financial crisis. The ECB never really got rates off zero. The Fed managed to get rates back up. But now everybody's at zero. So what we've had over the course of the past decade has been US interest rates being at a premium or higher than European rates. And so this rate differential from between Europe versus the US has very steadily moved in favor of the US. So in other words, US rates were able to rise post GFC. Eurozone rates really simply weren't. At the same time, the inflation differential between the two was very, very stable. So the green line shows you that Eurozone less US inflation was kind of steady at around minus 0.5%, while nominal rates were declining very steadily over that time. So why do I care? If you look at the right-hand side of the screen, that real interest rate differential, so the difference between Eurozone and US 5-year forward real interest rates, has been steadily declining and steadily driving the dollar up against the euro. So real interest rates have been the main driver for the dollar, almost without a doubt, over the course of the past decade. Now that rates are stuck at zero for the Europeans and for the US and for most of the rest of the world as well, this real interest rate differential isn't going to be able to drive the dollar. So the first order move is the Fed collapses rates to zero, matches the euro rates, and immediately there's weakening pressure on the dollar, and we've seen that. So one of the sort of consensus trades in the market out there has been for several months, weaker dollar. Fine. This is going to persist because with rates stuck at zero, the other factors that you would look at to drive the dollar come into play. Like, for example, the US current account deficit. That is a dollar bearish factor, and it hasn't gotten better over the course of the past few years. It's gotten worse. Growth differentials probably will not favor the US dollar. So there's going to be bumps along the way. There are no straight lines in nature, and there are no straight lines in financial markets. But we think that one of the most powerful trends out there is going to be a weakening dollar. So, so this is going to be a part of what drives, part our broader approach to managing assets. So if you put it all together, what do we have? We have a lot of disparity in different parts of the economy. Some parts are doing surprisingly well, goods, for example, and services doing very, very badly. This creates a lot of pressure. It creates a lot of future problems, as the service sector is the biggest part of the economy, and so we have the potential for a double dip recession. But we also have a lot of these other factors which are at play as well. We have this drive down of interest rates to zero, which they're going to be pinned at for the foreseeable future. We have real rate differentials taking away the support for the dollar, so we're going to have a weakening dollar story. So how do I play this in the markets? How do we find opportunities to generate return for our clients? Well, if markets are going to be moving broadly sideways, there's going to be a lot of activity underneath the surface. So different sectors, different styles, different parts of the markets are going to do better than others. Just to take two that I'm looking at right now, that follow on from that interest rate story that I've just told you. MSCI World Value has been really a kind of a phenomenal underperformer over the past 10, 15 years versus growth. So value stocks are ones that look attractive on a price to book or kind of valuation metric. Growth stocks are ones where the market really foresees that future earnings look very, very attractive. Now, as interest rates are declining, those future earnings for growth stocks are discounted at ever more attractive multiples and are brought forward into current prices in sort of an inflated way. That's stopped now that interest rates have hit zero. This then allows value stocks to sort of step out of the way of this headwind. And we think this is going to be a real theme. So a rotation away from growth stocks, which have been all the rage for the past decade, and into value stocks, which I think are probably going to be doing pretty well for the next couple of years, is a follow-on from what we've seen happen in the Treasury market. Similarly, cyclicals. Cyclicals have done generally pretty poorly relative to defensives over the past decade. And again, it's for the same reason. In that declining rate environment means that the annuity-like future returns for defensives, they look a little bit better when you're discounting them back to the present. That flattering effect from rates no longer plays a factor. That means that cyclicals are going to trade versus defensives based on other economic drivers than just rates. So that headwind for the cyclicals versus defensives trade that's been provided by ever declining interest rates is going to get taken away. So we think that there's probably a rotation opportunity here to go back into cyclicals. In fact, we've already seen a lot of that start to happen. And we think this kind of an opportunity probably has legs to run. So there's sort of two things that I'm trying to draw out from these examples. One is that there's a lot of differentiation in the market. So even though the broad markets are probably not going to reward a buy and hold for the long-term kind of investment, the sort of passive investment strategy is probably done for the foreseeable future. There's going to be a lot of movement underneath the surface, and that movement gets unlocked by what's happened in the interest rates market. there's going to be a lot of opportunity, some of which would be, for example, in Europe. We like the euro, some of which would be in value, some of which would be in cyclicals. And those are some examples how we're thinking about the next few quarters in the markets. So at this point, it probably is helpful if there aren't any questions immediately, for me to hand it over to my colleagues, Adrian and Jeff, because they're going to give you a little bit more depth and insight into what we're seeing right now in the fixed income market.
Thank you, James, and welcome everyone. Now, within the last quarter, fixed income hasn't really done too much. As James has mentioned before, we've been going sideways a lot. And what I want to show is that the Fed actually came out with a very big policy change, which actually indicates to us that rates will be on hold for a while. But it's not just the Fed that's going to be keeping rates on low. There's other factors which are forcing them to keep rates very low. And also, what can we do in this environment to find a modicum of yield? We've seen that the actual debt levels have increased, not just on a government side, but also on the corporate side. So this is something that we have to be very aware of and what the implications are for the future. So, as I said, what we've seen is that this pandemic has led to a lot of fiscal stimulus. It's now projected that the actual debt to GDP level will actually be higher than we had for the Second World War. We're going to be over 100% of debt to GDP on a government level alone. This is a lot. But what's even more worrying is that the CBO came out with a study, and they said that basically we are going to see the debt reach 195% to GDP by 2050. So what does this mean for the bond market? We know there's going to be a lot of debt coming out there. We know there's going to be a lot of supply. But we've actually got also projections from the CBO. And they've actually said and concurred with the Fed that rates, they don't expect to go up significantly until really 2025 onwards. And what we see is that at that point, if we look at the chart on the right, we can see that the US outlay as percentage of GDP is increasing. But what is that increase being driven by? It's actually being driven by the net interest outlay. So what this means is the CBO expects that the sheer volume of debt combined with the refinancing of existing debt in the future and the interest payments means that the federal deficit will increase massively over the next few years, from 2025 onwards to 2050. This is scary. The Fed is aware of this. Everyone is aware of this. They're aware that revenues, they don't really project to increase much. So what does it mean? Potentially we're going to have rate hikes, or we're going to have to see some kind of fiscal austerity coming through going forwards. We also decided to sort of have a look at what the CBO did on the government side for the US deficits going forward to see what happens to the US corporate bond market. And frankly, I'm quite scared about this. It may be something which is not evident right now, and it may not happen over the next 5 years or so, but at some stage, people will have to start realizing that the actual amount of interest that the bond market, the corporate bond market, and here I've just looked at the investment grade only, is going to be paying out each year, is going to be increasing, and it almost increases exponentially. Companies at the moment are enjoying a period where they can refinance very low. They basically have extended their duration, which is something that Jeff will talk about in a little bit. And they've used that debt to buy back equity. Great for equity holders, for debt holders. We've seen increased leverage. They may have liquidity right now to survive. However, a lot of these companies are going to become zombies to this interest payment going forward. And this is overall bad for the economy. Now, when we put this picture together of what's going to be happening on the corporate side and the federal side, the Fed knows that if it's not careful in the way it manages any rate rises or expectations, we are going to see a potential explosion of people not wanting to own US debt at all in the future. This is sort of one of the reasons why overall I am underweight and remain underweight on US fixed income, especially on the government side, where there's very little yield to obtain within the market. So moving on, what this chart shows you is actually how government bond yields have evolved over the last 20 years for both the European and the US bond market, government bond markets. Fixed income, you've got to remember, is where you are getting your money back from a secure country, hopefully. The country that's not going to default on you. And you're getting a fixed return for it each year. You know what it is. This is your carry. This is what really drives your total return. You're not really there to play for the price action. And unfortunately, as we can see, over the last 20 years, yields have been dropping massively. And as a share of the market, we can see that the low yields, which are in the dark red, like 0 to 1% onwards, has become a dominant factor in the market. Right now, if I was trying to find bonds which actually offer me more than 1%, only 24% of the US government bond market is able to achieve that. That's not much. And what's even worse is when we drill down, it's really only long dated paper, like 30 years or above, which starts offering me more than 1%. And it's the same picture in the US and Europe. And to give you an idea of how hard it is to find yield now, in Europe, we now see Greece hitting a low of 90 basis points again. So getting 0.9% for Greek yield. So what do we have to do to actually find some yield? So if we move on, we can see that one of our options is to increase our universe by actually adding investment grade bonds. Doing so gives us some more bonds and some extra yield that we can potentially achieve. But it's not great. Remember that a lot of these high yields will be triple Bs, which are potentially moving over into crossover sort of territory. So look at the 1 to 10 years, we can see that only 7.5% of the universe actually provides me more than 2%. Once again, I'm going to have to increase my duration to actually achieve a yield of over 2%. If I start doing that, suddenly I've got just under 20% of the universe. So this is the biggest problem for the coming quarters, years, is we have a debt explosion on the federal side, corporates who have huge amounts of debt. We know that rates are on hold and they have to stay on hold, but we seem to be picking up nickels and dimes in front of steamroller, hoping to get out before it moves, because we're being forced not just down the credit quality, but also extending the duration of our portfolio overall. So we now have to start thinking of strategies where maybe we basically take some long dated bonds, like 30-year bonds, when yield is nice and suitable, but also having a larger bucket in our shorter term. So overall, we manage our duration and try to keep the duration of the portfolio still relatively underweight. So at this stage, I'd like to hand over to Jeff, who's going to talk more about the problem of duration in the credit markets and how it's been increasing.
Great, thanks, Adrian. Yeah, so as Adrian says, one risk we've been paying a lot of attention to in the fixed income markets and our portfolios is duration. And if you remember, duration intuitively is the period in which you get paid back the principal that you've lent. And it's a function of two factors. Number one, it's the coupon size, and second, it's the maturity. So the shorter the maturity, the sooner you get paid back, and the higher the coupon, the sooner you begin to recoup some of what you've lent. Now, unfortunately, what we've seen in the markets is the opposite. with the combination of the Fed reducing interest rates to virtually zero, what you've seen is that coupons have converged closer to zero and have fallen. And with the recent deluge of refinancing activity through the primary markets, a lot of that has been to both shore up liquidity, and it's also been driven by the Fed's pledge to back the investment grade markets. What you have is longer maturities as well. So in combination of these lower coupons and longer maturities, that gives you longer duration. And that's a problem for investors. It's great for the corporates and the issuers, but for bondholders, it does pose a problem. And if you look at this chart where we've split duration by the credit rating tiers, it's risen at the most rapid rate for the highest quality credit rating tier, the AAAs, and overall for the investment grade bonds altogether, it's risen by 2 years, from 7 to 9 years over the last 24 months. And duration, it's a risk that is more pronounced because a higher duration portfolio is at risk from both the increase in interest rates, and it's also at greater risk from rising inflation too. And we think one of these two will occur in the near future. But aside from duration, we do have some positives in the market, particularly looking at cash balances on corporate balance sheets. If we just pop back one slide, I'd just like to speak about where we are in the current liquidity cycle. Looks like we do have a slide missing, but that's fine. I can illustrate the point through words. We are at the peak of a new liquidity cycle. What we saw following the dot-com crash and also the 2008 financial crisis, in the immediate aftermath, corporates raced to the markets to raise liquidity. And that pattern of corporate behavior after both of those economic downturns has been repeated this summer, where we saw a very strong rush of new bond issuance. So companies were looking to raise cash, shore up liquidity, ensure that they had cash to meet their working capital needs and to meet their debt obligations as well. Now, in the chart that I did want to show, the cash to debt ratios in the market are now at the highest they've been in 2 decades. They're currently sitting at 15%. So that's 15% of cash to every dollar of debt that the company has. Now, what we've seen is that earnings stress has been more acute in COVID impacted face-to-face sectors, but liquidity improvement has been less prejudiced, and it's been more broad-based, where we've seen even the sectors that have been struggling being able to raise cash quite easily. So we think that there's ample cash reserves now, and they're largely in place to help companies weather any further lockdowns and any prolonged disruption to economic activity that we see in the near term, given that we still have vaccine uncertainty, and then we're also seeing a reintroduction of lockdown measures as well. So combining these two factors, how does that affect our portfolio positioning? Well, given the prospect of rising inflation, the inability of central banks to raise interest rates to combat it, as Adrian alluded to, we do have a preference for shorter dated instruments, as we think that the liquidity risk that was present in the markets in the first half of this year has diminished, but we do have elevated duration risk now. And just to take a step back and briefly explain this chart, I've plotted both investment grade in US markets and European markets, also the high yield markets and emerging markets, and I've plotted the average duration of those subsegments of fixed income versus the average yield. If we start with sectors, there's an explanation to the duration of particular sectors. You can see that US investment grade healthcare has a duration of more than 10 years, and that's because there are long drug development cycles, and also there's a 10-year patent protection in the US on branded drugs that provides So you get 10 years of cash flow stream before any particular branded drug faces generic competition. And what companies do is that they try to match their liabilities with the length of their income streams and their assets. You can also see utilities as a long dated sector. The decommissioning of power plants usually happens multi-decades after they're first built. And even looking at renewable energy now, the MPV calculations for wind generators are now based on a lifespan of 40 years. A decade ago, they were based on a lifespan of 25, but now with improved engineering and also longer wingspans on wind turbines, we actually do have a reliable life of 40 years. But looking at the shorter dated sectors, they tend to be more cyclical. You've got the auto space, which is typically, traditionally, a short duration sector. And that's because you, on average, a vehicle, a particular model of a car, gets upgraded every 5 years. Now, it may have facelifts every year or every other year, but the main cycle upgrade occurs on average between 5 to 6 years. Also, you've got the home builders. And the lead time, that's between a home buyer actually placing a deposit for a home and that through to completion, that period is somewhere between 12 to 24 months on both single family homes and also multi-family homes as well. So we do have this preference, and as James spoke about earlier, about the rotation to cyclicals in equity, that's also reflected in our preference in the fixed income space, where we're now thinking of rotating away from defensives into cyclicals, given where we are in the credit cycle and the business cycle as well. And combined with the strong cash balances, which are typical of early cycle activity, as we saw in the previous, well, as was absent in the slide that's missing, we think that the low rates as well will support auto finance loans, will keep delinquency rates low, and will keep mortgage underwriting growth strong, as we've already seen. And this is how we're aligning ourselves, given the recent developments.
Thanks, Jeff. If there are any questions, please feel free to throw them in, and we will make sure when we send around the final version that will include Jeff's missing slide, because it was quite an interesting slide for you guys to look at whilst he was trying to talk through it. Just before we move on to the equity section, just a couple of sort of dots that I wanted to try and join. You know, if you did spot good news when it comes to bonds, please let us know, because there's not much of it going around at the moment. And that, on a sort of serious note, from a portfolio construction perspective, means that when we are trying to build this concept of balanced portfolios or growth portfolios, the contribution of overall portfolio return from fixed income is getting squeezed further and further along the duration sort of ladder, or down the credit ladder. And that is, you know, where we are having to be very, very careful and specific with the issuers and particular issues that we are comfortable holding, bearing in mind sort of the maturity, placement on the capital structure, and so on. And that's sort of the core component of a standard balanced portfolio. Separate to that, when we're looking at some of the equity holdings, again, if we look back to sort of 2009, post-global financial crisis, your primary driver of returns has been more US equities than European equities, more US tech than almost any other sector. And one of the key determinants of your performance over the last 10, 11 years has been how much US technology exposure have you had in your portfolio. One of the big questions that we've been looking at our end is, can this US tech outperformance continue? We've been selling our exposure in MasterCard, which has done very well, Alphabet, and is starting to trim down our Amazon exposure as well. We have 3 companies that have all performed very well since we purchased them into the portfolio, but looked a bit rich from a valuations and earnings expectation side. on the equity component of our portfolio, and our big focus here before I pass over to Misha is less about how much equity exposure do we have in the portfolio, because given some of the numbers that we saw earlier, we've seen a lot of discrepancy between US versus European versus UK performance, and sector sort of technology versus almost everything else. It's what are the drivers behind the names that we are owning in the portfolio. So when we're looking at the US election as one example, more short term, but we're trying to look at 2021 and beyond, and asking ourselves the question, what is going to be the next drivers in this new normal economic environment that we are now in. When we started deploying into our COVID-19 resilience strategy and buying up some of these e-commerce technology names and seeing very, very strong performance over quite a short period of time, but now looking at how do we move forward? How do we go into 2021? So the challenge for the equity team has been less on what's happened over the last quarter and more on what do we think is going to be interesting going forward, partly from an idea perspective, partly from which stocks kind of fit within those ideas, and why do we think that that is what's going to be driving us from a returns perspective. So the fixed income and equity component are quite different in their focus, but deliberately so. And I'm hoping that you find what Mikhail and Maksat are going to be talking about with respect to some of the ideas, drivers, and individual companies that sit within those interesting to listen to. So I am going to ask Mikhail to join right on cue, and I'll pass it across to you. Over to you.
Good afternoon, everyone. Thank you, Simon. So thank you for introduction. Yes, we're thinking that definitely equities parts should be focused on particular themes, and going forward, we expect that that at least one big topic is inequality gap. So, and this is one unfortunate consequences of the pandemic, and we're thinking that three key areas which investors should be focused on. So these are video games and video streaming. So we're thinking that video games and video streaming, they gonna get their target audience from customers who get their income less than average, from those who looking for value for money, and those who switching from other types of entertainment which is not available in this moment. We're also thinking that luxury goods gonna get additional demand, and we're thinking that luxury good industry, after losing revenue from tourist luxury good spending, which seems permanently lost, and we're thinking that this industry will return to growth next year, and we expect the industry will be growing for the next several years substantially higher than the world GDP. So speaking about income inequality gap, let me start by showing you results from one paper which we managed to find. It's been published by the Center of Economic Policy Research, and they expect that Gini index going to be rising next 3, 4, or even 5 years. And as a reminder, the Gini coefficient is widely considered to be the most scientific and accurate measures of income disparity. So one could say that it's just only theory, but unfortunately, this theory already started to get its confirmation. And we've seen that, for instance, in the UK, those households with income less than 35,000, they faced with a drop in their savings. While for those households with which income more than 35,000, they've seen that their savings rising. So, and we're thinking that this will affect their consumption patterns, and we're saying that at least 3 key areas are gonna get boost from this situation, namely luxury goods spending, and also video games and video streaming. Speaking for smarter way of spending money, and because of consumers will get some consumers from income below average will get less money in their pockets. We're thinking that it's worth to look how different types of entertainment compare to each other based on cost per hour. So let me demonstrate this study. So you can see that in terms of cost per hour, video streaming and video games one of the most attractive. And that is why we're thinking that those who are looking for value for money should get from video streaming and video games the most. We also thinking that those types of entertainment, which sitting on the right-hand side of this slide, live sports and concerts, because they're simply not available, and those customers can shift to the different types of entertainment. Also, it is the case for cinemas, because we heard this week that actually Cineworld said that they will not gonna open most of their cinemas until 2021. And this will be the second driver for getting additional revenue streams for video streaming services and for video games. And we've seen that after initial elevated level of activity, video streaming and video games, they still enjoying elevated levels of user engagement. Speaking about our short list, speaking about our top picks, so these are Ubisoft, Electronic Arts, Tencent, Codemasters, Embracer, and Disney. So we like these companies, and we're gonna talk about two of them in more details. Namely, we're gonna talk about Ubisoft and Disney in this presentation. And for this, let me ask Maksat to join me and continue this presentation.
Thank you, Misha. Good afternoon, everyone. Thank you for joining us today. Let me talk in more detail about the first low-cost entertainment option, which is video games. And this industry this year has been one of the few direct beneficiaries of the COVID. And this has resulted in the increase in the share price of all video games companies. And as a natural result of that, the valuation has also gone up. However, there are still some attractive opportunities within the space. And if we look at the major video games publishers, we consider Ubisoft as the most attractive opportunity. There are basically two reasons for that. One is that Ubisoft has a strong portfolio of games, a very diversified portfolio across different genres, and those franchises have a strong fan base. And therefore, the revenue for Ubisoft is not concentrated. And if we look at profitability of the company, and specifically about, in terms of expected EBITDA growth and EBITDA margin, it has those parameters on par or even better than its peers. However, its EV/EBITDA multiple is low, which makes it more attractively valued. And over the last couple of weeks, there has been a major catalyst for the company, which is the announcement of a new cloud gaming service by Amazon called Luna. And Amazon chose Ubisoft as its partner for the launch, which further highlights the strength of Ubisoft's portfolio. And just to provide you a brief summary on cloud gaming, and the key aspect of the cloud gaming is that it significantly reduces the entry price for consumers. So instead of paying a big sum of money upfront on the hardware, i.e. buying like PlayStation or Xbox, consumers essentially have this money freed up to spend on the games themselves and the in-game content. And this directly benefits the content providers such as Ubisoft. Now, video games is not the only industry, as Misha highlighted previously. Another one low-cost entertainment option is video streaming, and on here we'd like to talk about Disney. As you probably know, Disney has launched its streaming service in November last year, and it has been a tremendous success so far. So as of August, Disney Plus has over 60 million subscribers. And if we compare Disney Plus to Netflix, for Netflix, in order to achieve the same level of subscribers, it took the company over 15 years, whereas for Disney Plus, it took less than 1 year. And the key contributor to this success is that Disney has an unparalleled portfolio of brands. So the company has almost 100-year history, and over this history, it has developed internally as well as acquired externally different franchises and brands. And then when it launched Disney Plus, it basically put all of the shows, all of the animations and films on the streaming service, and this is why it has been so successful, both in the US and on international markets as well. Now, as we all know, Disney does not operate in the streaming business exclusively. It has also other operations which have been impacted more negatively by the pandemic. But let me explain to you why we think that investors should look beyond the near-term pressures on the segments and focus on the long-term recovery. So the first segment is theme parks, and theme parks have been hit by the pandemic, both in the US and also in other markets where it has parks like Japan and China. And the company recently announced that it will be laying off 28,000 of its workers in the US parks. And although this is sad news for the economy and for the people, if you look at the company specifically, it means that operating expenses for Disney will go down. And it is now estimated that the break-even utilization rate for parks will fall from an average of 57% in 2019 to 43% going forward. Now, speaking about another segment, studio entertainment, which is basically films, and as James and Misha previously noted, cinema industry is another hardly hit by the pandemic. However, Disney is in a unique position where it has both the studio, which produces films, and the digital channel where to distribute their films if the cinema theaters remain closed. And on that, Disney has a plan B. So what it did with Mulan, it released, what it did with Mulan is it released the movie directly to Disney Plus in September. And now because it avoided cinema theaters, it means that every dollar that was spent on Mulan goes directly to Disney. And this affects the profitability of this segment. So we have seen some data indicating that in the first half of September, approximately 1/3 of US Disney Plus subscribers have purchased the movie. And if we multiply 9 million subscribers by the $30 cost of the Mulan, it will roughly give us almost the $300 million, which matches exactly the Mulan production budget and marketing costs. And now finally, the media networks, which is essentially Disney's TV channels, mainly ABC. The main profit driver there is advertising, and which in turn is driven by the programming and sports viewership. And just to briefly summarize, and without going into too much detail into the nature of American football, basically the recent developments have been that more leagues are now expected to play in 2020, which is positive for the NFL and in turn for channels and distributors like Disney. And also Disney's scripted programming is returning as well. So overall, Disney has two types of operations, one streaming, which benefits in the current situation, and another parks, films, and TV, which has been more negatively impacted. However, on the long term, we are positive for the company. And now moving on to the other spectrum of the consumer spending, we would like to talk more about luxury spending. So luxury spending can be broadly divided into the domestic consumption and tourist consumption. And although the tourist consumption has been impacted quite significantly by the pandemic and travel restrictions, the domestic consumption has been surprisingly resilient, especially in China. And Chinese consumers are the main driver of the luxury industry. So Goldman Sachs now estimates that luxury consumption for China for this year is expected to grow by 26%, which is astounding if you consider the overall economic situation. And within this space, we like names with strong brand portfolios, so namely LVMH, Kering, and Moncler. And despite the recent drama around LVMH and Tiffany M&A story, we still think LVMH is one of the, if not the strongest luxury name in the space, with its portfolio over 70 brands and a very long history, and continue to view this stock as attractive. Right. On this, if there are no questions, let me pass back to Simon. Thank you.
Perfect. Thank you, Max. It's always good to start filtering out from themes to the sort of drivers of the themes and then looking at some of the underlying companies themselves. We are running probably a little bit tight on time, so we're just over an hour in. You'll be pleased to know that we are now on to our last topic, which is our special topic of the US election. So we're going to ask for James to jump back in. There he is, right on cue. And over to you, James.
Hi, Simon. Thank you very much. And let's get into this. So, U.S. election. Wow, the risks around this election are absolutely unprecedented, and we've really never seen anything like this in history. It looks like we're going to have a blue wave, but I think the message from what happened 4 years ago is you absolutely cannot assume anything until the last vote is counted. And indeed, in this case, it might even go beyond the last vote being counted. We'll also get a little bit into what it means for the next administration. If it's a Biden administration, we're probably talking about some changes in the policy front, and that could have an impact at the margin on particularly on the equity markets, but also the fixed income markets as well. So let's dive into it, Simon. I feel like I've used the phrase unprecedented too many times this year, and I thought I was done with it once the markets kind of stabilized in August. But then the U.S. election kind of came along. So we've seen something that I never thought we'd ever see in the volatility market for equities that I think really helps to illustrate just how unique this circumstance is. So if you think about the implied vol curve, the futures curve for implied volatility, typically what happens is there's a downward slope or an upward slope. So the front month to the second month to the third month, they're all going in the same direction. So either volatility is really high and it's sort of tapering off into the future, or volatility is really low, but it might pick up a little bit up into the future. When volatility is really, really high, that's typically when you get these sort of collapses in the market. You know, we saw in the beginning of the lockdown recession, you know, the market collapses, so volatility immediately spikes up. In the global financial crisis, same story, but still monotonic. What we've seen in the current environment, and that's what I've got in the slide in front of you in this sort of yellowish orange color, is that there's a kink in the volatility curve. So it's low for October, it's high by about 2.5 vols, which is a lot for November, and then it comes back down again for December. And this never happens, ever. Now, why is this? The markets are really nervous about something. So if we take a step forward, Simon, what the markets are scared about is that there's going to be a disputed election. Now, over the course of the past couple weeks, the odds of a Democratic victory have really risen quite sharply. Donald Trump has been he's been sliding in the polls quite a bit. The details of the U.S. political system are arcane, to put it mildly. but there's a lot of strategy that's involved in trying to engineer a victory, and it ends up coming down to a few key swing states. Now, what I'm showing you on the right-hand side is what these 9 or 10 key swing states look like right now for Biden, and they've all swung into the Democratic side, in favor of Biden having a victory. And in fact, since this chart was developed, which was only a day and a half ago, it's actually gone more in Biden's favor. The coronavirus outbreak in the White House has not been good for Donald Trump in the polls. So right now, it looks like if Biden were to hold the states that I'm showing you, the swing states that I'm showing you, it looks like Biden would have a landslide victory in the Electoral College. And that would be something that the markets would definitely take note of. Even if we expand to look at what's going on in the Senate, it looks right now like the Democrats have about 2-to-1 odds to take the Senate. And I'm getting these out of 538, which is it's a forecasting company that I really think do excellent work. Now that would suggest to you that the markets would have very little uncertainty, that it looks like it's going to be a blue wave, for better or for worse, whatever you think about democratic politics, whether you like them or you don't, doesn't really matter. It looks like that's going to happen. The problem is that there's so much uncertainty as to whether the incumbent will accept the results of the election on November 5th. Will he say, okay, we still have mail-in ballots coming in. I may have won with the in-person polling, but we're going to wait and hold off to declare victory until the mail-in ballots are fully counted, which is going to take some weeks. If he challenges and disputes the election, it gets very, very messy, very, very quick. That is the risk that the financial markets are pricing in. That is the concern that people have, and that is why this is such an unprecedented election. So let's have a closer look as to what this might mean for specific markets. We'll start with the fixed income markets, and I'll hand it over to my colleague Adrian.
Thank you, James. As James has said, the odds are for a Biden win quite conclusively, I would say. But the biggest risk to the market, I would say, is, as James said, Trump just not accepting the result of it. And as such, that would be the only scenario that we see for 10-year treasuries to actually see lower yields. In all other scenarios, whether it's Biden or Trump or divided control, we actually see, flat to high yields, and probably the scenario which James has outlined is the most probable of a Democratic control of both the Senate and Congress would actually lead to more fiscal stimulus, potentially high inflation. This is what people will be thinking about. There'll be higher taxes. There'll be more regulatory environment. This will lead to a higher level of yields than we're seeing currently. This is another reason why overall we're underweight on government bonds in this coming quarter. On China, which is the other big impact for the elections, both parties, whether it's Trump or Biden, will basically be tough on China. They have to be. But it's how they actually handle their stance. Biden will probably take a different tone and go with their allies. Overall, we think that ranges are going to be dominating, and it's a question of whether we move towards a higher range. And if we see that on Biden's win, we'll probably start actually looking to buy some bonds just in case it starts getting contested. We've also had a look at IG and high yield, and especially on these two sectors, the underlying interest rate will have an impact. We see that it's mainly a worse environment for high yield under a blue wave, and also for IG, just because of the potential impact of more fiscal spending and higher spread levels. And you have to be very sector specific. And I think this is a good point to hand over to Mikhail, who'll be talking about certain sectors.
Thank you, Adrian. Let me go through a scenario of Democrats retaking both White House and Senate, and what does it mean for the market. We've seen at least we expect at least two consequences for the market. So tax hike and big tech regulations. So one of the most novel aspects of Biden's tax plan is the introduction of book tax. So as proposed, the policy would impose a 15% minimum tax on the firms with 100 million in earnings. And so we estimate that utilities, energy, and communication services, these sectors will be hit the most. Overall, we estimate that the full implementation of the Biden tax plan will result in a 9% decrease in 2021 net earnings for S&P 500. So the 9% of corporate earnings contraction will almost fully offset 10% of earnings expansion due to Trump tax cut in 2018. But we don't want to say that earnings contraction will necessarily mean drop in S&P 500. So because of actually what could happen that the decrease in earnings could be offset by Biden will be more open towards international cooperation, and we can expect that he will remove certain trade barriers, and this will be support earnings. Speaking about the second part, about big tech regulations. So first of all, why this topic so hot? So that's true that in certain markets, let's say Google in search, it's dominant. It just occupying 81% of the market. Facebook got 1.8 billion users globally. So these clear monopolies, or at least dominant players in their respective markets. While we're thinking that if Democrats, if they set majority in Senate, they likely to establish new antitrust law. And we think that breakups is less likely because of it's very difficult to imagine that, let's say, Facebook will have, like, nobody will have two social network, pages. So also very difficult to imagine that Google will be split because of Google big because of its good, so because of its good in search. And we're thinking that investors should be cautious around investments in sectors which get the hardest hit due to proposed taxation, and also investments in the US big tech names, because of we're saying that the story just in the beginning, and we are proposing investors to take less aggressive bets on them. And if there is a profits, we decided to take some profits in Amazon, in Google, in MasterCard, and we thinking that it's get their underlying reasons. Yeah.
Perfect. Thank you, Misha. Just a quick chance for anyone to punch in any questions if they want to, but I appreciate that we have been running for about an hour and a half. It's quite a lot to get through when we're doing a sum up of the previous quarter for some aspects, and then trying to take a little bit of a look forward into 2021. I will just say thank you very much for joining us this afternoon as we're running into this evening. And we will follow up with the slide deck and a link to the recording. And if you haven't got any questions, please feel free to either contact one of us directly or email straight into your relationship manager. And please feel free to visit our website if you have some other pieces that you're after. Otherwise, thank you very much for joining. We appreciate you taking the time out of your days to spend it with us. And we hope that you're all well. Until the next time, goodbye.